I'd like to put a little bit of light on volatility. Volatility is a measure where you find the deviation from average past prices. But since it's an intraday volatility, the basic fact is that we cannot get any average. It's high, low or open close. So the question is volatility bad? Anybody has thoughts about it? Volatility is basically the efficiency parameter. It is good or bad only to be able to reveal once you are able to identify the efficiency, how efficiently it represents your market. Reasons for volatility: more the competition, more the volatility. More the leverage. Leverage means more the debt component in a company, the volatility of that particular stock market, of that particular nation. More the MNCs, more the volatility. The reason behind this is that more MNCs means more the network, more the country that have been taken care of by that company, in the sense it would create more volatility. Macroeconomic indicators, and plus these days we find currency crisis as well as political crisis. This is which is majorly driving volatility. Objectives of our studies are: we have calculated the risk. Moreover, we have also gone towards the comprehensive study. We have found that there is a comprehensive study requirement for intraday volatility. Moreover, whenever you find investors who get carried away or who are in a panic state because they are not able to identify the volatility behavior, they get scared if it is going high or it is going low. Our research methodology has been towards higher order moments, that is skewness and curses. We have first of all identified how the data has been. Our data set was of 10 years from 2000 to 2010 for BSc as well as Nifty. But we have identified that, and the parameters around this skewness for 0.03 and curses around 3, where we found that data is not normal, and we have done the log normal for it. Lastly, as well as creating the squared return, we have done the average of annual squared log returns versus square root of squared normal returns for top 5% of returns. So to exemplify or to elaborate on this, first of all what we did was we created the log returns. We did the square of the log returns and then we averaged for all the possible returns. So it is just an average of squared log returns. Then what we kept the methodology is that 5% of the top log returns, squared log returns, we did the square method. Two models we have used here. One is Parkinson model, other is German class model. Parkinson model is the realized volatility that I have quoted. It means that we have only checked high and low in a day. German class model tells me implied volatility. That means it is also covering close and open. If you look at the variable before close and open, it's 2 log 2 minus 1. Its value is around 0.748. And if you look at the variable before high low, it's 0.5. So the fundamental behind German class model is that they are putting more emphasis on open and close. One more model is there, that is of Roger, that we have skipped. The reason behind is to create a difference between high low and open close. Roger is also referring open close model only. I hope everybody is able to view the numbers around here. So you can see that 2000 and 2001 has shown negative mean returns and shown higher standard deviation. If you go to 2004, you find negative skewness as well as very high curses. And same is the case with 2008 and 2009. If you also see the returns over here, this is the peculiarity. Entire 10 years you would not find anywhere average going higher than the top 5%. I just want you to please look at it. The reason for 2000 and 2001 was that the globalization and liberalization just started off. The sentiments were negative in terms of risk averseness. People were not ready to be very much confident towards liberalization in our country. 2004, can anyone make a guess why all of a sudden the economy saw that kind of return?
Enron.
It was basically because the government changed. So that was a sentiment that has affected skewness as well as curses. And 2008 and 2009, as the world knows, it's the recession period. So in the end, I have concluded few conclusions out of the study, that the average returns were higher in both the stock exchanges. Over the world, entire investor forum as well as investors are looking to averse their risk or diverse their risk through investing in India. returns are more predictable when the volatility is higher. That's a strange thing, but it is a fact. Moreover, negative news affects severely than the good news. I have also done comparison on inter as well as intraday. Intraday is high-low, wherein if the volatility is high, that means dispersion as well as extreme movements are high. But if you do the intraday study, open to open as well as close to close, when you find high open to open volatility, that means that there has been excessive information inflow. That means since the US stock market closed just before India stock market and UK stock markets opens at 12. So if you find some negative effects after opening up of UK market or closing of US market, that means the information that is provided by our Indian economy is not symmetric. That's why I have used the word information is asymmetric. It is being affected by other markets to a great extent, and plus there is an overflow of information. And the last conclusion that I have driven from the entire study is that Nifty is more volatile as compared to BSE. If you want to send your queries, you can send on my email, as well as I have a Excel video solving group also on FB. You can please get in touch with me.
Any queries? Okay, I have one on the slide after the table. Yeah, after the table. This last point, good news, negative news has either effect than good news. Like
Yes.
How do you touch? I think
Actually it's done by T-GASH model. But generally in our study, what we identified with the perspective of log returns, we converted that we were aware that this was a negative news. Say for example, if I want to correlate it, what we were aware that these were the 2000, 2001, then 2004, that was the news of election, and that too of recession. So the negative sentiments was under the recession period, and our German-Pakistan model is providing us open close as well as high low volatility at a higher end as compared to the previous sentiments that we observed. So these were more negative, and if you look at our information on 2000 and 2001, where the news was positive. Liberalization and globalization were affecting our economy positively.
But yet intraday volatility.
Yeah.
And here what you are showing is the averages for the entire year.
Yeah.
But when we say good news or bad news effect, how have you condensed it for the year? Like, because good news, bad news.
Yes, sir. Over the period of time, what we have done is that we have done the average of intraday returns.
But when the point is when we want to see the effect of the news, we say, okay, this news has come.
Yeah.
On that particular day or the day, second day, third day, what is the effect?
Yes.
When a good news comes and a bad news comes, and we classify good news and bad news.
Yes, in this study we have correlated one more thing, open to open, wherein we have correlated the US markets and UK markets information to them. That is basically, and moreover we have also averaged it over the period of year also. That was the thing. Had I been just showing you the entire year from Jan to December, then that point wouldn't have been there. But since I have averaged it for past 10 years, so that way I have tried to reflect the same.
Okay. Yeah, another queries? Fine? Yeah, thanks.